Hello and welcome to our MoneyFit live webinar this week. My name is Todd Christensen, Education Manager at MoneyFit, and today's topic is trends in consumer credit reporting and scoring for 2020. And actually, we're going to go back a few years to take a look at what has happened since about 2015 or so. What are some of the changes? What do they mean for us as consumers? So let's go ahead and get kind of right into it and pretty quickly. 2015. Now, back in 2015, the three consumer credit consumer reporting agencies, Equifax, Experian, and TransUnion, got together, and what they did is they came up with a plan to improve the reporting of our information on our credit on our credit histories. They did included quite a few different things on their changes. One was they made it so if you want to get your credit report, if you want to dispute something on your credit, you did not have to sign up for a credit or an account with the program. You did not have to pull a credit report first. You can dispute the item, and in fact, after disputing it, and if it's successfully disputed, you actually get a copy of your credit report. It does not count against your annual creditreport.com that you get every 12 months from each of the three credit bureaus. There were some minor things in there, or not minor, but some uncommon things like if you report the death of a consumer to one credit bureau, it will be shared with all three. And then there are other things involved. They want to make sure that all the reporters, all the lenders that are reporting information to the credit bureaus, they're all using the same format to standardize the information to make it more likely to be accurate. That's a requirement now. There were a few other things that we'll get to that went into effect over the next few years, but a lot of this is really some very positive things that they realize, that there's becoming an outcry of a lot of criticism about how our consumer credit reports are gathered and how the information is used, and to kind of prevent further deterioration of that public image. They kind of got together and made some changes on their own before it was kind of forced upon them. Now let's go ahead and look at 2017. We have the VantageScore. Now, if you have ever got a free credit score, if it doesn't say FICO score, it is 99% or higher that it is a VantageScore. VantageScore is a collaboration between the three consumer reporting agencies, Equifax, Experian, and TransUnion. They got together about 20 years ago and wanted to come up with a competitive credit score to FICO, which has essentially a monopoly at 95% of all decisions based on credit or FICO scores. So they launched their first score back, at the beginning of in the early 2000s, with the idea that it was going to be a lot more user-friendly. They even created the version specifically to look like our grades from school. There was A, B, C, D, and F. The score was anywhere from about 500 on the low end up to about 990 on the upper end. With their VantageScore 3 in the early 2010s, they decided to start going back and mirroring the FICO score with a low of about 300 and a high of 850. Even though it's not user-friendly for consumers, that's the kind of score that the lenders are used to. And if they wanted to actually make inroads with lenders, they needed to start changing, making it more lender-friendly. In 2017, the VantageScore 4.0 came out. And some of the things that happened here is they said, we're going to no longer look at or no longer consider a factor whenever a collection account is paid off and paid in full. So if you have a medical debt or an old credit card or an old utility account, a cell phone bill that went to collections, if you pay it off, doesn't matter if it's been only a few months since you were first received the notice, or if it's been 10 years, if you pay it off, doesn't matter if it's going to stay on your report, but it is no longer a factor in your credit scoring through that credit bureau. That is a great opportunity to improve credit and pay your debts, because the way it generally works with the FICO scores is if you pay a collection account, even if you bring the balance down, paying it off in full restarts the 7-year reporting of that account as a collection to the credit bureau. So it can kind of balance out. Yes, you're paying down the balance, but now you have a collection account, a brand new collection account, or renewed essentially, shows up for another 7 years, hurting your credit. The VantageScore 4.0 says, no, we're not going to do that anymore. That's great. Problem is that Vantage scores are used by very few people. They are not used by lenders. And so it really, as far as your credit score, might help your Vantage score, but it's not going to do much for any score that a lender will use. Okay, let's move on to 2018, see what happens in 2018. This is a big deal for most consumers. In 2018, in May, Congress passed the law, and it was signed into law and went into effect in September. It was basically updating the Fair Credit Reporting Act. It's been around for a couple of generations. And what this law update did is it says every consumer, every adult now has the right to freeze their credit report and to do it online, and it's basically instantly. Freezing your credit report, here's what it means. You request that the credit bureau freeze your report. Nobody gets to see it for any kind of new application. If you already have an account with a credit card company, they're going to be able to still see your credit for their typical reviews. Nobody's going to be able to see that account and send you or pre-qualify you because you did not give approval for anybody to look at it. You can, if you still want to, apply for a loan. You just thaw it, and it can happen pretty much instantly. You go online and you thaw your account. You thaw it temporarily, or you can thaw it as on an ongoing basis. If you were going to apply for, let's say, a home loan, and you find out, okay, which of the credit bureaus or all three is the lender going to look at, you go on and you thaw those relevant credit reports, and you say, okay, they're going to look at it on Thursday, so maybe you just give it till Saturday, and it will refreeze. You can identify when you want it to freeze again. The great thing here is that no legitimate lender is going to open up a new account in your name if they can't see your credit report. There are these fraud alerts that you could put on there, and this law actually changed that to go from you put a fraud alert on your credit report, and it used to be just 3 months. Now it's 12 months. But a fraud alert, all that does is it tells you the potential lender or the potential credit card company or creditor generally says, oh, there's a fraud alert on here. Make sure you're doing your due diligence to ensure that the person who is applying for the loan actually is the person who they say they are. What that means is the lender is probably going to ask you for your social security number and your date of birth. If your identity has been compromised, the identity thief already has that. So it doesn't really do much. Freezing your report is the best thing you can do to protect yourself from identity theft, and it's free. You have to do it at each individual consumer reporting agency. You have to go to Equifax.com, Experian.com, TransUnion.com. You sign up for a credit freeze, and each one will make you sign up for an account or a password or a PIN, a personal identification number, and you cannot go back in and thaw or refreeze without that PIN. If you lose it, then you are going to have to go through the password or the PIN reset process, and it's pretty standard, and you can get that done in a matter of a few minutes even. But if they don't have the PIN, nobody's going to look at your report. Great opportunity to protect your identity. And here's another thing that this law did. It also gave you, if you are a parent or if you are responsible for any dependents, whether it's a minor child or whether it's a protected adult, you now can freeze their credit report for them as well. You're gonna have to do it by mail. You can go online and start the process, and you can fill out the form, and then you print it off and you mail it in, but you have to send off some documentation proving for example, you'd have a birth certificate, something like that, or social security card, or maybe proving your guardianship. That way, the child or the adult, if they ever apply for a line of credit in the future, they're not surprised by identity theft that may have been going on for years or even decades. It's a great opportunity to protect the identity of the ones you love and care for and are responsible for. So that's a credit freeze. Now here's what else happened, and this was a result, as I mentioned back in 2015, of the NCAP, or the National Consumer Assistance Plan. One of the things they said is, we are going to get rid of most of the records, or several of the types of records that typically end up on a consumer's credit report under the public records section. Traditionally, they had judgments there if you had ever sued by a credit card company you owed money to, or by a collection agency, or if you had tax liens. Those were traditionally in your public records section, and they could be renewed forever, as long as whoever had won the judgment renewed it before it expired. And expiration varies by state, a couple of years, up to 10 years, I think. As long as they renewed it every few years, it would stay on there indefinitely until you actually satisfied it or paid off that debt. The other one that was traditionally there is the bankruptcy. Now that is the only type of record you will find under public records on your credit report, is a bankruptcy. And it's there for 7 years if it's a Chapter 13 or a repayment plan, or if it's a Chapter 7 or a liquidation, it's there for 10 years. All the other types of accounts, the judgments and the tax liens, those are no longer under the public records section. It had a very minor impact, typically. So the credit reporting agencies, when they analyzed it, they realized it wasn't going to be that big of a deal, and it was a lot of work, and there was a lot of complaints about it. So that was one of those things that they corrected, or they felt it was in their best interest and in the best interest of consumers to make that change. So that's public records. 2019. Now, there's a couple of changes here that are quite monumental. It's a shift in the way our credit is, the direction it's headed. Traditionally, anytime you get your credit rating, it is based on credit-related information. Activity on loans, payments, balances, so forth. The status of loans. Are they in collections? Are they being paid as agreed? The number of loans, the age of the loans, how long you had them. But everything has been related to your credit activity. 2019 saw the beginning of a major shift. First of all, with the launch of Boost in, I believe it was early May of 2019. Experian created and launched this product called Boost, and they're the only ones that have it at the moment, or anything like it, where you go on and you sign up, you enroll, and then you give them access to view your checking account. It's read-only. They're not going to be able to make any changes or withdraw any money. And then you identify for them the utility bills that you're paying with that account. You say, okay, this bill here, this payment here, that was for my electricity bill. This payment down here, this was for my heating bill or gas bill. This bill over here, that's for my cell phone bill or my internet bill. And now going forward, Experian monitors your account. Anytime those are paid and they're paid on time, you get credit for making a payment on time, just as if you were making a payment to a credit card company. Huge shift in the way things work. You're now able to build credit based on non-credit activity. And so from there, it wasn't just Boost. And the problem, one of the challenges, of course, it's just Experian. TransUnion, Equifax have not launched anything like this at the moment. Hopefully they'll get into the act as well. But there are other products as well going on. You've got credit cards. There's one that's called Pedal. You can go to pedalcard.com. I think we don't have any interest, financial interest or any other interest in the card. Low or no fee cards that do the same, that can qualify you for the card based on the same sort of information. If you don't have credit or have had poor credit, they can now take into account your utilities, your cell phone payments. I think they even can take into account your rent payments. This sort of stuff will actually help you build your credit, qualify you for that card. And then if you use it wisely, it will report to all three of the credit bureaus. By wisely, here's what I think is wisely. Do not carry it with you. Don't take it into any kind of consumer decision-based scenario. Don't take it into a store. Don't add it to your online wallets, nothing like that. But you just pay for one single small account a month, have it recurring, maybe like a Netflix or Hulu or a Disney Plus or even a cell phone bill. Not huge, it's just a small payment purchase. You pay it off every month. That's building credit. This is really exciting what happened in 2019. The way that we are able to now to build credit without actually using credit. That principle has been around a long time. Questions, I've gotten that question a lot. How am I supposed to build credit without using credit? Because a lot of people don't want to use credit. Now you can. Now you can. It's great. It's a great opportunity. UltraFICO. This is another product that was launched on a pilot program in 2019. And it's a little different. Again, it does base its decision on non-credit activity. What the big thing about the UltraFICO is that it looks at checking and savings account balances and looks for patterns. Are those accounts balances going up and up, or are they always constantly zero or worse, less? So the UltraFICO, it is another service. And the great thing is FICO, well respected. It's the dominant player in credit scores. The downside, like all these other services, very few lenders are actually using it. They were piloting it with some big players, but most are not using the UltraFICO. It takes years, if ever, for a FICO score, a new model, to be adopted by a majority of the industry players. Many industry lending companies don't want a new score. They're quite happy with the way their current score is working. FICO does a great job, and VantageScore for that matter, does a great job of predicting likelihood of defaults. And so if a lender says, we don't want to go with a new score that's going to be more expensive and that we're going to have to change all of our systems to accept, we're just going to keep where we're at. So it's great. UltraFICO is awesome, but most of the lenders at the moment are not using it. So that's UltraFICO. Now, 2020, just at the beginning of this year, in 2020, FICO launched yet another score. It's the FICO 10 score. A FICO 10 score, like the earlier FICO 9 score, will not count your paid off medical bills as much or at all as other score models would. In fact, what the FICO 9 did is they said, okay, if we're going to give you now half a year, we're not even going to consider medical debt, whether it's in collections or late, we're not even going to consider that until it's at least 6 months old. That way, you have 6 months to deal with your insurance company to get the payments made. Not only that, then they said, and then if it hasn't been, payments have not been fixed or taken care of after 6 months, and it really is the insurance company's responsibility, and it will go on your report. It's not going to hurt as much, but once they pay it off, once the insurance company pays that account, again, it's no longer a factor in your credit score. Problem is, again, not very many people. It's going to take a while for mainstream lenders to start using the score. The big thing that the FICO Score, Score 10 did is that they are now relying even more heavily on histories or patterns of balances. FICO has never been a snapshot. You can't say, oh, I've had terrible credit, but I got my tax return, I paid off all my debts and they're all paid off, zero balances, and now I have good credit. No, it doesn't work that way. FICO is all about predicting future behavior, and the best predictor of future behavior is past behavior, so that it's not current status, it is past behavior. And the more recent, the better. It's true. But it can go back as much as 7 or even 10 years to find information that is a reliable predictor of future behavior. So what FICO 10 does is it looks more at balances over time, the history of your credit card balances, the history of your car loan balances, of your student loan balances if you're out of school and in repayment, the history of your mortgage balances. It looks at balances on a long-term thing and not just as only looking at the current balance, which has been more of the case over time. So that's FICO 10. That's again another big deal. It can have basically what it does, it makes their credit score even more reliable as a predictor of future behavior. Doesn't mean it's going to help or hurt. Generally, it's just going to try and be a better predictor. So let's just look to finish up here. Let's just look at some score trends since from 2005 all the way through 2016, or excuse me, 2018. You can see that credit scores have been going up. From the depths of the recession in 2009, you see that it was at 686. And in early 2018, it had already gone up by almost 30 points. That is approximately 6 percentage points. After 2018, it has continued to go up a bit, and I think it's getting close to 710 as an average. But that just doesn't say that, it doesn't mean anything about the scores changing. Scores are still predicting likelihood of default. What it says is that we are, as a whole, we're just doing better with taking care of our credit. I think the idea that the credit is important, not just for loans, but also for your car insurance premium, life insurance premium, for your homeowner's insurance, but also for getting a job and other getting into an apartment. That it's a factor in many different aspects of our lives. I think we're much more likely to work on that. And about 42, as you can see here, about 42, I think it's 42% have a credit score at about 750 on up. Now, yes, 750, 760 is generally considered excellent credit, but you can't say everybody at 750 has excellent credit. Excellent credit is only defined by the lender, the individual lender. Some lenders will say, okay, if you have excellent credit, means we'll give you the best interest rates that we have, but to get our best interest rates, you have to have a 790. We're very conservative. You have to have excellent credit. There are other lenders who say, oh, you want our best interest rates? We'll give them to you at about 700. We are a little more liberal with our credit. It just varies. But in general, most lenders are going to look at a score in the 750 to 760 range on up as excellent. Even from 700 or even 690 on up, you're going to qualify for the best mortgage rates through an FHA loan. But there are quite a few people still in that 600 or below. That's the what we typically call the subprime market. Lender or borrowers who have and are continuing to struggle to make payments as agreed. Lots of collection accounts, lots of overdue debts, lots of maxed out accounts, bankruptcies, foreclosures, that sort of information on their report. But overall, the number of those with excellent credit or really good credit scores have been going up and up over the last 10 years or more. Okay, a few rumors just so that you if you've ever heard, these are still rumors. There still continues to be talk of legislation in Washington, D.C. about making it possible to get a free FICO credit score. You might think, well, I'm already getting a free FICO score from my bank or from my credit card company. Yes, but no. Yes, it is a FICO score, but no, it is not the FICO score that any lenders would ever use for making decision on loans. These are generally out of date or unused FICO scores that the FICO has sold to these credit card companies or the banks, saying, hey, here's an added on, a value add for your clients. They can look at it. Yes, they are helpful. It's the same thing with if you go to any other kind of service like a Credit Karma or Mint where you get a free score. Those are going to be like the free Vantage scores. They're helpful. They're educational, but they're not scores that lenders are using. Use them, absolutely use them. I use them. Use them and look for patterns. And if you see your scores going up and great, you're doing great, and nothing changes on your activity, but all of a sudden your score drops unexpectedly, that's a sign somebody maybe is opening and using accounts fraudulently. So yes, use them, but don't use them as the basis. Don't expect them to be the basis of any credit decisions in the future. Currently, the law says we can get a free credit report every 12 months from each of those three consumer reporting agencies, Equifax, Experian, and TransUnion. But we are not able to get a free FICO score. That would be something that would have to happen legislatively if Congress wants to do something like that. That's the big one. Let me also mention this about the future of credit scoring. If we're talking about recent trends, let's just kind of project out a ways. You've probably heard of blockchain technology. Blockchain technology is not the same thing as Bitcoin or cryptocurrency. Bitcoin is something that is based on the blockchain technology, but is not the same thing. There's a lot of different services that can be based on blockchain technology. Highly recommend that you learn more about it. It is something that will eventually be much more prevalent in our society. But blockchain technology, basically it is the digitization of transactions, and not just financial transactions. We're talking about exchange of information. You make a purchase. Yes, the blockchain will store that, and it's not on an individual computer. It's on multiple computers that are, yes, you can hack into one computer, but if you want to change the reality of the blockchain, you have to hack into every single computer individually. It's just really very decentralized, really about the securest thing that you can think of. It's the real deal. A lot of concerns out there about, some magic hacker is going to figure it all out. Not going to happen. So let's say you make a purchase of a home. Not only is it going to say, here's how much you paid for the home, it's going to have the information on there about the date. And if there's ever, we get to the point where any kind of lien would have to be on a blockchain and tied to that. There's a lot of things a lot of professions that are going to be much less like what they are now. Title companies, for example, buying a home, they are all about, can you trust the information of the buyer? When we get to the blockchain technology as being accepted generally, there's not going to be any need for that sort of thing. You can say the same thing about a lot of the services that accountants are doing for their companies. The information will not be something that will be generated with creative math or creative figures. It'll be available for all. Now, the same thing can be said for the future of consumer reporting agencies. As blockchain technology grows, all of your transactions and my transactions, they will eventually be available publicly to an extent on blockchain. So that if a potential lender, if you're asking for a loan, they're not just going to check your credit report, they're just going to check your blockchain information, and they are going to be able to trust that 100%. They're not going to wonder, did something get left off this credit report? So credit scoring, the credit consumer reporting agencies are likely not going to disappear. I don't think they're going to disappear. I think they're going to transform instead of into the curators of the information, the gatherers and the distributors, more likely into the interpreters, like a FICO score, FICO technology. So they'll take all that raw data, and then you're still going to have to figure out how to predict the future. Blockchain won't do that, but it's going to be a much more reliable information upon which you can base future predictions. So that's blockchain technology. Okay, that's it for the day. Here's what I'd like you to do. If you would like a certificate of completion, it's free. It's a PDF that's delivered to your email instantly. Go to bit.ly/2020 credit trends. No dashes, no spaces, no dots except there in between bit and ly. Enter your name, how you'd like it on your certificate, your email address you want it sent to, just a little personal information where your location. We don't need personal address or anything like that. And then it'll ask you for the passcode. The passcode is 0220 trends. Again, no spaces, no dashes, no dots, no capitals. So that is 0220. It's not 0220. It's 0220 and then lowercase TRENDS. That's what you want to go to. And that's the information you want to enter in, and you will get a certificate of completion immediately. Thank you for joining me today. We're going to do another course, another MoneyFit live next week. Again, 1:30 p.m. electric, 1:30 p.m. Eastern time. Let me get my Atlantic and Eastern mixed up. 10:30 a.m. Pacific. And we rotate through different topics. Sometimes we throw in one just like this that is very unique that we might only do once a year or so. But I hope you'll join us then. You find our archive of past live webinars at moneyfit.org/live-archive. In fact, if you just go to moneyfit.org/live, you'll see the upcoming webinar, and then right underneath it a button to access all of our archived ones. Great having you here today. Hope you have a great afternoon. If you have anything else we can help you with, do see us at moneyfit.org.